What if every single month $1,000 landed in your bank account, without working extra hours, without side hustles, and without selling anything, just money showing up because you own the right investments? Sounds like something only rich people do, right? Not really. In this video, I'm going to show you the exact math behind earning $1,000 per month in dividends, how much money you actually need, and which realistic paths people use to reach this goal. No hype, no shortcuts, just clear numbers and simple explanations. Let's break it down step by step. Step 1. What $1,000 per month in dividends really means. Before talking about investing, we need to understand the target clearly. Making $1,000 per month in dividends means earning $12,000 per year in passive income. This money comes from companies or funds that pay shareholders a portion of their profits. Unlike trading, you don't need to sell your investments to get paid. As long as you hold the shares, dividends keep coming. For many people, $1,000 per month can cover rent, groceries, or basic living expenses. For others, it's extra financial security or freedom. But this income doesn't happen by accident. It depends on how much money you invest and the type of dividends your investments pay. That's where dividend yield comes in. Step 2. Understanding dividend yield. Dividend yield is the key factor that determines how much money you need invested. It's simply the percentage of income you earn each year from an investment. For example, if a stock pays $4 annually and costs $100, that's a 4% dividend yield. Some investments pay lower yields but are very stable. Others pay higher yields with more risk. The higher the yield, the less money you need invested to reach $1,000 per month. However, higher yield often means less safety. That's why understanding yield helps you choose the right balance between income and risk. Now let's look at 3 realistic dividend yield scenarios and see how much money each one requires. Step 3. 3% dividend yield, low risk, high capital. A 3% dividend yield is common among large, well-established companies and dividend index funds. These are businesses with long track records and stable cash flow. To earn $12,000 per year at a 3% yield, you divide $12,000 by 0.03. That means you need about $400,000 invested. This is the safest approach, but it requires the most money. Many retirees and conservative investors prefer this strategy. Because dividends are more reliable, even during economic downturns. While it may take longer to reach this level, it offers peace of mind. Safety and stability are the main advantages here. Step 4. 4% dividend yield, the balanced option. A 4% dividend yield is considered a balanced and realistic goal for many investors. This yield is commonly found in dividend ETFs, utility stocks, and strong real estate investment trusts. These investments are known for generating stable cash flow over long periods. At a 4% yield, earning $12,000 per year requires about $300,000 invested. This approach lowers the total capital needed compared to lower yield strategies. At the same time, it still maintains a reasonable level of safety. Many long-term dividend investors aim for this range because it offers steady income without taking extreme risks. This balance makes it suitable for both growth and income-focused investors. With consistent investing and reinvesting dividends, reaching this level becomes achievable over time. Dividend growth can further increase income without adding new money. For most people, a 4% yield provides balance between income, stability, and long-term financial peace. Step 5. 6% dividend yield, higher income, more risk. A 6% dividend yield can significantly reduce the amount of money required to reach your income goal. At this level, you only need about $200,000 invested to earn $12,000 per year in dividends. These higher yields are commonly found in REITs, high dividend stocks, and income-focused funds. At first glance, this income level looks very attractive. However, higher yield usually comes with higher risk. Dividends at this level are more likely to be reduced or suspended during economic downturns. market volatility can directly impact these investments. That is why diversification is extremely important. Relying on a single stock or sector can be dangerous. A 6% yield can work well if you clearly understand the risks involved, and if you spread your investments across multiple companies and sectors. Higher income always comes with trade-offs. Smart investors acknowledge this reality and plan carefully before chasing high yields. Step 6. You don't need this money today. One of the biggest misconceptions in dividend investing is believing you need hundreds of thousands of dollars right now. In reality, dividend income is built slowly and steadily over time. Most successful investors start with small and manageable monthly investments. Amounts like $200, $300, or $500 are very common starting points. What matters more than the amount is consistency. As dividends are reinvested, compounding begins to do the heavy lifting. Your money starts earning money. Over a period of 15 to 20 years, consistent investing can grow into a powerful income-generating portfolio. Time matters more than speed in this process. The earlier you start, the less pressure you face later. Even small amounts invested regularly can lead to meaningful dividend income. You do not need perfection to succeed. You need patience, discipline, and time. Progress always matters more than perfection. Step 7. Dividend growth makes it easier. Another powerful factor is dividend growth. Many companies increase their dividend payments over time. That means your income grows without adding new money. A stock yielding 3% today may yield much more later. This growing income helps protect against inflation and speeds up your journey toward $1,000 per month. Dividend growth rewards patience. Investors who focus on quality companies often see steady increases. This is why dividend investing isn't just about yield, it's about sustainability. Step 8. Final summary and mindset. Let's put everything together. To earn $1,000 per month in dividends, you need $12,000 per year in passive income. That income does not come overnight. It depends on how much you invest and the dividend yield you choose. At a 3% yield, you need about $400,000 invested. At a 4% yield, you need around $300,000 invested. At a 6% yield, you need roughly $200,000 invested. There is no perfect number that works for everyone. The right number depends on your risk tolerance, time horizon, and comfort level. Dividend income is not a shortcut to quick wealth. It is a slow, steady, and disciplined path toward financial freedom. The key is to start where you are. Invest regularly. Reinvest dividends early. Stay patient during market ups and downs. Small, consistent actions over time can lead to powerful results. If this video helped you, make sure to like and subscribe for more simple investing content. Comment below and let me know. Are you aiming for safety or higher income? I'd love to hear your thoughts. Share this video with anyone who wants to start building passive income. Thanks for watching, and I'll see you in the next video.